Gold hit an all-time high earlier this year and continues to trend upward into 2026. Oil has surged past $100 a barrel. Meanwhile, the world is sliding deeper into instability, wars escalating, tariffs rising, currencies weakening, and governments printing money they don't have. In other words, every macro condition that should be pushing people toward Bitcoin is already here. Samson Mow, CEO of Jan3 and one of the more serious voices on Bitcoin adoption at the government level, said this publicly. "I really don't think there is anywhere else to go but to Bitcoin, and this trend will simply continue as more uncertainty arises in the world. Bitcoin is on the way to become the reserve asset of the financial system. There is no top. Here is the problem. The world Mow described is here, and Bitcoin is down 47%. That is not a small thing to brush past. That is the whole video. Gold is doing exactly what gold is supposed to do in times of global uncertainty. Bitcoin, which has spent years positioning itself as digital gold, is moving like a tech stock. It sold off when equities sold off. It bled when the Nasdaq bled. And that is a real question that deserves a real answer, not just another bull case deck. So today we are going to put Mow's thesis directly against what the market is actually doing, bring in 3 analysts who see this very differently from each other, and try to figure out whether Bitcoin's divergence from gold right now is a crack in the thesis or just the setup before it proves itself. No cheerleading. Both sides get a fair hearing. But here is what is different this cycle. This drawdown happened at the same time as a genuine global risk-off event. The US entering a military conflict with Iran, oil spiking above $100, and equity markets entering correction territory. And in that environment, Bitcoin was supposed to go up but has been grinding up and sideways. In 2020, Bitcoin also dropped sharply when COVID hit. It fell from $9,000 to $3,800 in a matter of days. But that crash happened in March, and by October it was already back above the crash level and climbing. The recovery was fast because the macro conditions that followed, Fed money printing, stimulus, and cheap liquidity, were rocket fuel for Bitcoin. Right now, the Fed is not printing. Interest rates are still elevated. Liquidity is not flooding the system, and that matters for understanding why Bitcoin has not recovered the way some people expected. That is the honest setup. That is where we actually are. Mow's core argument is structural. He is not talking about the next candle on the chart. He is saying that as the global financial system becomes more uncertain, more people will want an asset that nobody controls, nobody can inflate, and nobody can confiscate. Bitcoin is the only asset that fully fits that description. Therefore, the demand for it has no ceiling. That is a coherent argument. And if you believe it, you could make a case that a 47% drawdown is noise against a decades-long thesis. But here is what Mow's thesis does not fully explain right now. If geopolitical uncertainty drives capital into Bitcoin, why did the Iran conflict drive capital into gold and out of Bitcoin? Gold has been held as a reserve asset by central banks for centuries. Bitcoin has been around for 16 years. The trust gap between those two assets is enormous, and it shows up exactly in moments like this, when real fear enters the market and institutional money decides where to park. The thesis is that this gap closes over time. As more institutions, more governments, and more pension funds allocate to Bitcoin, it will start to absorb fear the way gold does. That argument is reasonable, but over time is doing a lot of work there. And right now, in March 2026, that transition has not happened yet. The data is right there in the price. It does not mean Mow is wrong long term, but anyone presenting his thesis without acknowledging this very obvious short-term reality is not being straight with you. Now here is where a different angle enters the conversation. CryptoTice, a widely followed analyst on X, made a very specific claim recently. Bitcoin has never gone parabolic without this signal, and it just triggered. Oil bottomed. Every single Bitcoin parabolic phase in history was preceded by an oil bottom, not once, not twice, every single time. Smart money already knew this. they've been positioning quietly while retail watched the price drop. The logic: oil peaked above $100 on the back of the Iran conflict. It is now pulling back as markets begin pricing in a potential de-escalation. And Tice is saying that oil topping out and cooling off has preceded every major Bitcoin parabolic run in history. That is a genuinely interesting correlation, and if you go back and check the data, the timing does hold across previous cycles. Oil peaks, liquidity conditions ease, risk appetite returns, and Bitcoin has historically run hard in that window. But here is what you need to hold alongside that. 3 data points do not make a law. Bitcoin has only had a handful of major parabolic phases. Saying a pattern has held every single time sounds compelling until you realize every single time is only 3 or 4 instances. Correlations between oil and Bitcoin are also not causation. Both assets can respond to the same macro conditions, Fed policy, global liquidity, and risk appetite without one actually causing the other to move. Tice's signal is worth watching. But every single time from a 4-cycle history is not the same certainty it sounds like. Mo has also said this: bears often insist on staying bearish until some arbitrary condition they set is met. That's just not how the world works. Bitcoin will just run back up without warning. Suddenly is very sudden. This is the statement that makes bears uncomfortable, and for good reason. Bitcoin's history genuinely backs it up. In 2020, the bears were waiting for the economy to stabilize before getting back in. Bitcoin went from $3,800 to $69,000 while they waited. In 2019, the bears needed regulatory clarity. Bitcoin went from $3,200 to $14,000 in 6 months without it. The pattern is real. Bitcoin does not wait for permission. But here is the honest counterpoint. Being patient has also been right at specific moments. The people who sold Bitcoin at $69,000 in November 2021 and waited were right for over a year. Anyone who bought at $60,000 in that cycle had to sit through a fall to $16,000 before seeing a new high. Mo's framing can make it sound like staying bearish is always wrong. It is not. Timing matters. Being early to a bull position in a bear market still loses money. The real lesson Mo points to is not that bears are always wrong. It is that the window to reposition is usually much shorter than people expect. That is worth taking seriously without treating it as a guarantee that the bottom is already in. Now for the analyst who sees this most differently. Symbiote, a technical analyst on X, posted a chart recently and said, Bitcoin formed a huge dump pattern. Back in December, Bitcoin had a fractal with a further 40% dump. The same thing happening right now means Bitcoin can fall to $50,000. His argument is straightforward. Bitcoin consolidated in December 2025, broke down, bounced to a lower high, and then continued lower. That same sequence is playing out again right now. The bounce from $63,000 to the $67,000 to $71,000 range is, in his view, the lower high before the next leg down. If the fractal completes, Bitcoin falls to roughly $50,000. What would have to happen for this to play out? Bitcoin breaks below $63,000. That is the February low. If that level gives way with real volume behind it, the $50,000 conversation becomes a lot harder to dismiss. What would invalidate it? Bitcoin is holding $63,000 and pushing back above $75,000 to $80,000 on volume. That breaks the structure Symbiote is pointing at. You do not have to agree with him. But here is the thing. Fractals have worked in Bitcoin before. The 2022 bear market saw exactly this kind of grinding lower high structure before the final flush to $16,000. Anyone who dismissed that pattern at $40,000 had a painful few months ahead. The level to watch is $63,000. Everything else is secondary until that is settled. And then there is Crypto Fergani, who posted one of the most aggressive takes you will find in this market right now. He said Bitcoin will never trade below $60,000 again. He called the current sentiment the perfect setup for a parabolic move. He compared Bitcoin to gold and silver, said those assets pumped 100% to 200% in a year, and then dropped the headline number. Bitcoin at $500,000 this year is possible. His core logic is contrarian, and it is not crazy. Sentiment in crypto right now is as low as it was near the bottom of the 2022 bear market. The Fear and Greed Index is deep in fear territory. Social volume on Bitcoin is near a multi-month low. The crowd is bearish, and the crowd has historically been bearish at exactly the wrong time. The gold comparison is also worth engaging with honestly. Gold's market cap is around $20 trillion. Bitcoin's is around $1.3 trillion. If Bitcoin reaches market cap parity with gold, you are looking at Bitcoin around $1 million per coin. That is just math. But here is what Fergani's post does not address. Saying Bitcoin will never trade below $60,000 again is a very strong claim. Bitcoin has made comebacks that defied expectations, yes, but it has also broken support levels that people said would never break. The $69,000 all-time high in 2021 was supposed to be a floor by 2022. It was not. It fell to $16,000. Nobody's floor prediction in this market comes with a guarantee. The contrarian logic is sound. Bitcoin not going below $60,000 this year requires things to go right that have not gone right yet. Fed liquidity, macro stabilization, and institutional inflows returning at scale. That combination is possible. It is not inevitable. The last thing Mo said that is worth sitting with. When Bitcoin surpasses $1 million per coin, the world will understand that it wasn't a risk asset. This is the most honest framing of the long-term bull case you will find anywhere. He is not saying Bitcoin is definitely a store of value. He is saying the proof of that claim only comes retroactively, once it has already happened. Look at gold again. When Nixon ended the gold standard in 1971, gold was $35 an ounce, and economists called it a barbarous relic. Nobody called it a store of value back then. That language only appeared after gold had already proved it by holding purchasing power across decades. The narrative followed the evidence. Mao is saying Bitcoin is in the pre-evidence period, and that argument is structurally sound. The people who bought gold in 1971 did not have proof either, they just had a thesis. But here is the uncomfortable part of that framing. It is also unfalsifiable in the short term. If Bitcoin drops to $50,000, Mo can still say the thesis is intact, just give it more time. If it drops to $30,000, same thing. The thesis does not generate a level at which it is proven wrong, at least not in the near term. That makes it hard to use as an actual decision-making framework for this year or even this cycle. It is a long-term conviction argument, and it should be understood as that, not as a near-term price signal. Bitcoin at $67,000 is in a genuinely contested zone. The structural case Mo makes is coherent. The contradictions in the current market are also real. Both things are true at the same time. The U.S. has a strategic Bitcoin reserve executive order in place, but has not bought at scale. The signal is real. The buying has not started. BlackRock and Fidelity ETFs are still open and still accessible, but inflows have slowed significantly since the all-time high. Bitcoin's circulating supply is at 20 million coins out of a 21 million cap, and that scarcity is real and mathematical. These are structural positives. But the Fed has not pivoted. Liquidity is still tight by historical standards. Bitcoin is still correlating with equities in risk-off moments, and the nation-state buying wave Mao has pointed to for years is still, mostly, theoretical. Watch $63,000. If it holds, the bull case has real legs, and the recovery story is intact. If it breaks, the symbiote's fractal plays out, and this conversation looks very different. Neither outcome tells you Mao is right or wrong about the long term. It just tells you what the next chapter looks like. That is where we are. One level, two very different roads. Let us know in the comments which side you are on and why. Thanks for watching. Don't forget to like and subscribe if this was useful. See you in the next one.